What are trading price patterns? Price patterns are visual formations created by the movement of an asset's price on a chart. These patterns are used by traders to anticipate future price behavior based on historical tendencies. Think of them as footprints left by the market's emotional crowd, fear, greed, and everything in between. Price patterns provide traders with predictive insight. They don't guarantee a result, but they offer probabilities, and trading is a game of probabilities. Understanding these patterns can help you identify potential entry and exit points, spot trend continuations or reversals, improve risk-reward ratios, and trade with more confidence and less emotion. Patterns are essentially a trader's way of reading the crowd, figuring out whether buyers or sellers have the upper hand and what they're likely to do next. Price action versus indicators. While many traders rely on indicators like the moving average convergence divergence or the relative strength index, price patterns give you direct clues from the market itself, pure price action. They strip out the lag and noise, letting you react to what's happening right now. Role of charts in pattern recognition. Charts are the canvas for all technical traders. Whether it's candlestick, bar, or line charts, each one tells a story. Candlestick charts are especially powerful for spotting patterns thanks to their detail and clarity. Market psychology and patterns. Markets are driven by crowd behavior. Fear of loss, greed for gains, it all shows up in chart patterns. Recognizing patterns is recognizing psychology, and that's a major edge in the markets. Just a quick reminder to hit the like button and subscribe to the channel. Also, visit us on the web at investmenttees.com and use code BLOG to receive 25% off your next purchase. Some of the most popular types of price patterns are head and shoulders pattern. This pattern signals a potential trend reversal. It appears with three peaks, a higher one, head, between two smaller ones. The neckline connects the low points after each peak. When the price breaks below this line, it often confirms a bearish move. Double top and double bottom. These are powerful reversal indicators. A double top forms after an extended uptrend and hints at a downward shift. The double bottom signals a bullish reversal following a decline. Both patterns resemble the letter M or W. Confirmation occurs when the price breaks through support or resistance levels. Rounding bottom. Also known as a saucer bottom, this is a long-term reversal pattern often found in weekly or monthly charts. It indicates a gradual shift from bearish to bullish sentiment. The pattern signals strong accumulation and is typically followed by a breakout. Flags and pennants. Flags are small rectangles that slope against the prevailing trend, while pennants are small symmetrical triangles. Both appear after a sharp price movement and indicate a brief consolidation before the trend continues. Bullish flag, pennant, follows an uptrend, while bearish flag, pennant, follows a downtrend. Entry is generally placed at the breakout, with targets measured by the length of the flagpole, the sharp initial move. Triangles. Symmetrical, ascending, and descending. Symmetrical triangles form when support and resistance levels converge. They usually signal a continuation but can break either way. Ascending triangles have a flat upper resistance and rising support line, bullish continuation pattern. Descending triangles have a flat support level and descending resistance, bearish continuation pattern. Triangles reflect market indecision, but once broken, they often lead to strong directional moves. Rectangles are trading ranges, also called consolidation zones. These occur when price moves sideways between horizontal support and resistance levels. Traders look for a breakout to confirm trend continuation. Breakout and breakdown techniques. Enter when price breaks above resistance, breakout, or below support, breakdown, ideally with volume confirmation. These moves are your entry points. Using stop loss and take profit, always protect yourself. Place your stop loss just outside the pattern boundaries. For take profit, measure the pattern's height and project it in the direction of the breakout. Combining with risk management, never risk more than 1% to 2% per trade. Even perfect patterns fail. It's not about being right every time, it's about surviving long enough to win big. How to identify price patterns. Visual clues on the chart. Train your eyes. Look for geometric shapes, symmetry, and repeated formations. Drawing trend lines helps you see them more clearly. Volume confirmation. Volume often confirms a pattern. For example, rising volume on a breakout means strength. No volume? Be cautious, it might be a trap. Support and resistance lines. These horizontal levels are the backbone of most patterns. They act like psychological barriers where price reacts. Watch how price behaves near them. How to trade price patterns effectively. Step 1. Identify the pattern. Use a clean chart with proper zoom to observe the pattern clearly. Avoid cluttered indicators during pattern detection. Step 2. Confirm with volume. Volume plays a critical role in validating price patterns. For most patterns, breakouts should be accompanied by increasing volume. They sometimes lack of volume may indicate a false breakout. Step 3. Set entry, stop loss, and targets. Entry. Just above, bullish, or below, bearish, the breakout level. Stop loss. Slightly inside the pattern, to minimize risk. Take profit. Measure the height of the pattern and project it from the breakout point. Step 4. Monitor and adjust. Markets evolve. Always be prepared to adjust your stop loss and profit targets based on market behavior. Conclusion. Trading price patterns is part art, part science. You're not just looking at shapes on a chart. You're interpreting the psychology of thousands of traders reacting to fear, greed, and hope. Whether you're a beginner or seasoned pro, mastering these patterns can turn your trading game from shaky to solid. But remember, there's no magic formula. Combine patterns with discipline, risk management, and continuous learning. That's how you turn potential into profits. Thanks for watching.